Hello, everybody, and welcome back. Today, my guest is Ivailo Dikov from Eastspring Investments. Ivailo is a portfolio manager in the Japanese equity team, and today we want to discuss recent investment opportunities in the Japanese equity segment. Welcome, Ivailo.
Hi, Thomas. Glad to be here.
Ivailo, the Ukraine war has global consequences and Japan is joining the sanctions against Russia. How much does the conflict affect Japanese companies currently?
Yes, Thomas, this is top of mind question at the moment for everybody in the markets, I think, and definitely for us as well. It's not surprising, but the direct exposure of Japanese companies to Russia is not that big, to the Russian market. This is not surprising as Russia's economy is not that big, and also as percentage of exports of Japan to Russia is very low, at close to 1%. The exposure of companies, the direct exposure to these markets is very low and manageable. For example, I can give you an example for the automobile manufacturers in Japan. They have 1 to 2% exposure in terms of volumes to the Russian market. So it's really manageable, and the direct exposure is not big. Where the really bigger problems could be is more like in the secondary effects of this conflict, and this is mostly expressed through the inflationary pressures in the commodities, and this leads to cost push inflation and cost problems for companies. So how companies are positioned to transfer these costs in their pricing, and their pricing power becomes very important going forward. Having said that, I would want to just emphasize that the Japanese companies are really entering in this period from a position of strength. They have really improved their operating profit margins in trend terms. So it's not only a cyclical improvement. We've seen fundamental underlying improvement in their operating profit margins. And operating profit margins really, even during COVID, when they fell sharply in the first half of 2020, they really fell just to the peak level of the previous cycle. So they're entering with really better cost structures. The companies have been really focused on managing their capacity, and that's how they've improved their break-even point. So they're coming into these situations from a position of strength. I think a big factor in what was driving this was also the corporate governance reform in Japan, and I think this is quite peculiar to Japan, because corporate governance has really pushed companies to increase the independence of their boards, and also to unwind cross-shareholdings. This has made the boards much more open and the management much more susceptible to challenge from shareholders. And that's really focused the mind of the managers to really improve the returns of the businesses they operate. So just to summarize, the companies are really slimmer, fitter, they're cash rich as they enter in this situation. And also, they've really managed their capacity well, and on an industry level as well. So I think that they're well positioned to transfer some of this cost push inflation onto their transaction prices. And that's what we've been hearing bottom up from our companies. They think there'll be time lag in the transfer of these costs into prices, but they're quite comfortable that they can manage in the current situation.
Hi there. Just a 2-second break. Before we continue with the video, just make sure to subscribe to our channel now to not miss out any updates. Thank you very much and enjoy the video now. Yeah, you already mentioned an important keyword. So inflation is back in the market. And how hard is Japan hit by inflation, driven primarily by energy and food prices currently?
Yes, no, so I'm not a macroeconomist, but from what we see, we do see inflationary pressures building up in Japan as well. More recently, some macroeconomists are looking for CPI, so the Consumer Price Index growth of 2% year on year in the coming months, which is a level which is watched by Bank of Japan. And as you mentioned, a lot of the inflationary pressures do come through energy and food inflation. But we also observe more kind of broad-based inflation. We could see it in some services and some consumer goods. So if I'm to link the inflationary environment to the markets, I would say that usually when there is a moderate inflation, Japanese markets and specifically cyclical and manufacturing stocks have performed well. And also, I think this inflationary environment is really is really challenging long entrenched views that Japan is really a place of constant deflation and that the interest rates are never going to rise and going to go stay very long time in the future. And I think ideas are being challenged. This also in turn challenges other narratives, right? Narratives around the valuations of expensive growth stocks or narratives around the continued struggles in the financials as that this could continue. But all of these beliefs are starting to be challenged as the inflation landscape changes in Japan.
So the past year was characterized by a style rotation discussion. Is it a good time to change from growth to value? Well, what is your current strategy and why is it a good time to invest in China via a value approach?
In Japan, right? Yes.
In Japan, yes, sorry.
Yes, Thomas. First, I just want to point out about the Japan market. I think it's still one of the cheapest developed markets at the moment. And as I mentioned before in our discussion, the companies have really improved their profitability in trend terms. So I think there is an element of this not still being recognized for the market as a whole. And you're right. In terms of I just want to move to the growth versus value discussion. And you're right that there was over the last year or so, value factor or value companies have performed well. But we shouldn't really forget that this is coming from a very bifurcated market. So even before COVID, but during COVID, this trend was really accelerated. But the growth companies, a really narrow cohort of growth companies, got beat up really a lot, and their relative valuations became very expensive versus the market, while other stocks were thrown away just on thematic preferences or risk aversion in the market. So what we've seen over the last 1 year is these value stocks have really kind of recovered some of this performance, but we still think we're still relatively early in this reversion, and this can still continue, especially in a situation where these companies, or these so-called value companies, have really improved their trend valuations, and the conviction in their trend returns has increased. Yeah, just want to take a moment and just to tell you about what our process is when we invest. We are viewed as value investors, but we are not simplistic value investors. Like we don't really just invest in stocks which are cheap on absolute price to book multiples or ratios, or people who just hope on mean reversion. The way we invest is we use value as a tool. We try to identify where the market might be wrong in terms of certain stocks, and we really focus on outliers where the market's perception has really changed, has become really negative, and these are really big outliers in the market where afterwards, after we identify such stocks, we do a deep due diligence on these stocks, and we really focus on forward-looking trend returns that these stocks can really provide or deliver. So this is very important. It's a forward-looking concept, and it's of trend returns that we are focused on, and we really focus on the outliers, on the places in the market where we think, on the stocks in the market where we think the market makes a significant mistake of how it evaluates them. And usually these are really big debates, and these biases in the market can continue for a long time. So we are willing to be patient if we are paid enough. And our conviction in these trend returns continues to be strong.
What Japanese companies and stocks do you think are a very good fit in a portfolio in the current difficult market stage?
So I would say in terms of, we don't really take an industry view. As I mentioned, we are kind of really focused on where the market might be making a mistake on a really stock basis. So we look through the whole market, and that's how we operate. And currently, at this moment of time, I just want to go back to your question. In our portfolio, we do have overweight in certain Japanese bank stocks, where we think that the management has really been focused on improving the cost base and also the capital allocation process. And they've become much more capital efficient and willing to return capital to the shareholders. And where the market is still focused on on its view of continued low, negative or low interest rates in perpetuity. Other areas where we find that interested and we overweight in our portfolios in the heavy machinery area, where the companies do have some short-term struggles in some of their main businesses, like COVID impacted businesses like aerospace parts manufacturing. But we at the same time see their management really more focused on capital allocation. We see this positive management behavior that we want to see from these companies. So these are just two examples of things that we overweight in the portfolio. In terms of things that we are still quite a lot of underweight in the portfolio, this is still, and it's probably links to what I explained previously, but these are the technology sector and technology companies, because we still think that these companies did quite a lot in the post-COVID period, and they're quite expensive at the moment. And although we've seen some normalization in the relative valuations, there's still a long way to look cheap to us. And we are not allergic to technology stocks. We've historically been overweight in technology, as this is a diverse sector where you could find very different and interesting ideas. But at this point of time, I think it's just the result of where valuations are and what we see, what's priced in these stocks. They're not still interesting for us.
So this was Ivailo Dikov from Eastspring Investments. Thank you very much, Ivailo, for being with us today and sharing your insights into the Japanese equities.
Thank you, Thomas. It was very good to talk to you. Thank you very much for having me.